Interest rates, a term we often hear, but do we truly understand how they affect our daily lives? From mortgage payments to savings accounts, interest rates play a pivotal role in shaping our financial decisions. But what are interest rates? When you borrow money, the interest rate is the fee charged as a percentage of the amount borrowed, and the level of interest rates is set by the central bank or government. They set the base rate to achieve the government's inflation target, which impacts borrowing and saving decisions made by consumers and businesses. How do interest rates affect our daily lives? For borrowers, higher interest rates result in higher borrowing costs and higher monthly payments. For savers, this can be beneficial as it causes interest rates on their savings accounts to rise. For investors, higher interest rates make new bonds issued more attractive. There are a few reasons that could lead to interest rates falling. One, if an economy experiences a downturn or a recession, a central bank may try to stimulate economic activity by lowering interest rates, thus encouraging borrowing and spending, thereby increasing consumer spending and business investment. Number two, if inflation has fallen sharply. To stimulate price growth and avoid deflation, banks may decide to lower interest rates when inflation falls below the central bank's target level, usually around 2%. Staying on the topic, let's look at the relationship between interest rates and inflation. The inflation rate is a primary factor in determining changes in interest rates, as central banks aim to maintain price stability. When the inflation rate rises above the central bank's target, the bank may decide to raise interest rates to curb inflation and stabilise prices. Conversely, if the inflation rate falls below the target, the central bank may lower interest rates to stimulate spending and boost economic growth. Employment and wage growth also influence interest rate forecasts because they affect consumer spending and overall economic growth. Central banks may respond to rising employment and wages by raising interest rates to control inflation and maintain price stability. This is because consumers typically have more disposable income to spend, possibly leading to increased demand for goods and services, and in turn, higher prices. When interest rates rise, monthly repayments on mortgages typically increase, putting additional pressure on mortgage customers' household budgets. The increase in interest rates is unfortunately bad news for individuals who are not currently borrowers, but plan to become ones, as they may have a harder time accessing mortgage loans. In the longer term, this could lead to a slowdown in the real estate market. If loan installments become too high, potential buyers may decide against taking out a loan or opt for smaller properties. Also, with current homeowners with higher monthly repayments, their consumer capacity will decrease over a longer period, further impacting the overall economy. Overall, we can see that interest rates have wide-ranging effects impacting borrowers, potential buyers, and overall economic activity. Make sure you subscribe to XTB to learn more about trading and investing.